Hi, welcome to this eMentor tutorial video. So in this video, we'll be going through a little bit of information about trying to think beyond just interest rate and the importance of factors other than just interest rate. So as a mortgage broker, your job is to be able to educate and provide knowledge to clients beyond just the interest rate. If you're just a rate to clients, often they will they'll find other providers who just offer them interest rates as well. So they'll just go online or they'll go to their bank. You need to provide value and information and overall value monetarily as well, beyond just the interest rate, and be able to explain to them how different products work in different ways and how the total value they can get from one product versus the other can be different. And the rate is just one factor in that value. So this is just a bit of a summary of some of the pitfalls if you just focus on the rate or if you have a high rate focus versus the benefits if you take a big picture view when you're dealing with clients. So having a rate focus is a bit of a narrow view. So it's like if you're going to buy a cup of coffee, just looking at the lowest price coffee and buying that one without knowing anything else about the coffee. It's also a short-term strategy as well for winning clients. If clients just see you as an interest rate, then next time when their renewal comes up, if there's a better interest rate, they won't stay with you. They'll just go wherever the best interest rate is. It's also harder to compete. Rate is more out of your control. There may be some situations where the bank's offering a very competitive rate, you're close, for example, or another broker or another brokerage has access to a different rate than you do. If you're just an interest rate, that's less control. You can't control what interest rates may be available to you at the time. Of course, a big part of your job is being able to provide the most competitive rates available, but you also need to explain why, show other value beyond just interest rates. So let's say, well, this rate is this type of product which may have these type of restrictions or may not be right for yourselves because of X or Y, and just outline all of the options. Of course, you'll need to be as competitive as with rate as possible, but if you're just competing on rate, it is harder to compete, especially as an individual broker when you're competing against large brokerages who may do more volumes, who may have access to different types of rates and products than yourself. You have less loyal clients and lower conversion ratios, so you may spend more time trying to find clients that aren't loyal or that may just back out at the last minute. So there will be times, even if you're not focusing on the rate and you're focusing on the big picture, that some clients are just rate focused. They'll keep playing you off against other brokers, against their bank until the last minute, and you do all that work. So you want to sort of try and just show why you have that additional value. So if you are offering the same rate as someone else, you want that client to always be choosing yourself because of everything extra that you provide. It's also less profitable. So sometimes you may need to buy down your commission to get a lower rate to be able to secure that business. If you're just focusing on rate and you're having to compete against other institutions or brokerages with more resources than you. So just focusing on rate, trying to get the lowest all the time is potentially less profitable as well, and less sustainable as for your business and for your time. There may also be product restrictions. So some of the lowest rate products actually have big restrictions. So lenders know this and they'll offer a slightly lower rate because they know certain clients are just focused on that one number and don't care about everything else. So they'll be able to benefit from this. Lenders, financial institutions, banks, they're not charities. They identify these areas. So they have products which are called restricted or no frills mortgages, where they have bigger restrictions. So one of them is the bona fide sales clause. So you can't discharge the mortgage unless you sell the property. So that can be or move the mortgage, port the mortgage, and keep the mortgage with that lender. So essentially it eliminates that flexibility to change lenders during a term if potentially you could change for savings or restructure your mortgage or anything like that as well. And that restriction can be really damaging as well. Higher penalties as well. So certain rates have much higher penalties. Fixed rates have much higher penalties than variable. You need to explain these different implications. If a client's moving in 6 months, you don't want to get them locked in. Even if the lowest rate right now is a 5-year, if the penalty is going to be $5,000, $10,000+, then that is a huge cost that will eliminate any interest rate savings. So you need to be able to explain the big picture, how different lenders, different mortgage products work, any penalties, any restrictions on those mortgages. Are they portable? Can you move them? What are the prepayment privileges, for example? Are there any discharge fees? Is there a cashback? Is that clawed back? There's lots of these different things that you just need to be able to explain when you're comparing lenders to clients beyond just the interest rate. So other risks as well. So sometimes there'll be really low rates that you can have access to, but it may be with a lender that just isn't the best to work with, or they have slow turnaround times, poor service, stricter underwriting criteria. There was previously, when HSBC were in the Canada market, they had briefly had I think it was a 0.99% interest rate, but their turnaround time was 30 days, which for any purchases is just not feasible to hear back within 30 days. So it may look great on the interest rate, but if that process is just not even workable for clients, if you can't get the deal done, that really is the priority. It'll only take you dealing with a lender that's really difficult and asks for a lot of documentation, or really makes the client jump through a lot of hoops, and that client will say, it's not rare that clients will say, I don't care about the rate anymore, I just want a lender that can get this done. And that's a big value as well, is that experience for clients, not only when you're placing their mortgage, but also during their term. It can be a really valuable and a really important thing to consider and explain to your clients as well. And then big picture view. What are the benefits of the big picture view? So having a focus on the product, as well as the not just the rate, is the big picture view. So product is the type of mortgage, so flexibility with the mortgage, the type of rate, not just the specific interest rate, the lender, all of those different things as well, is more of a big picture view, and you can really place yourself as a financial planner for someone's liabilities, for someone's debts. It's also a long-term strategy. If you want to retain clients, you need to show value above just rate. You need to be able to explain, okay, well, we want to place you in a mortgage which helps you get set up to be in the best position long-term. Yes, we will secure you a competitive interest rate, but that's just one part of it. We also need to just consider, how do we structure your mortgage? You know, what amortization is best for yourselves? Do you want a secured line of credit? Do you need flexibility if you may move down the line? There's lots of these different questions and value points that are really important to review with clients. Often they don't know what they don't know, and your job is to solve problems that they didn't know they had. You also want to compete on service, so that's within your control. Service is something that you are in control of. Whereas rate is determined by lenders. It's not something that you are determining. So if you're competing on service, then you can make sure that's within your control, and you can make sure that your service is superior to whoever you're competing against. If that's the bank, if it's the branch staff, what they offer in the branch is very different to what you'll be able to offer as an individual mortgage broker. So make sure you know your kind of competitive edge on that side as well. You'll also have more loyal clients. If clients trust your advice and appreciate the value beyond of what you offer, beyond just if they went to their bank or potentially other brokers, you'll have more loyal clients, and then you'll have higher conversion ratios as well. So out of the 10 people you speak to, let's say 6 of them place their mortgage with you rather than 2 if you're just focusing on rate. It's also more profitable. So you don't have to if you're just competing on rates, you'll have to sort of buy down the rates as much as possible to be able to compete in this area as well. So it's potentially more profitable for yourself to have that big picture view, as well as being more valuable for your clients long term to explain, you know, rate is one factor in how financially well or not you will do by being placed in this mortgage. Also, flexible products. So if you're not just focused on rates, then you'll be able to secure more flexible products for your clients. So for example, variable rate products maybe have higher rates than mortgages, or a HELOC product may have a higher rate than mortgage, but then if it's an open term and a client's moving shortly, there's no penalty. So there's different, it's about really understanding the big picture for the client and breaking down the numbers long term for them as well. If a client may want to restructure, if they have a history of maybe needing to consolidate debts during their term, they don't want to get locked in to a fixed rate, for example, where there'll be a giant penalty if anything bad happens and they need to restructure their mortgage or access equity during their term. You want a bit of that flexibility as well, and there really is value in that. And then lower penalties tied into that as well. So fixed rates, often the fixed rates or the restricted mortgage products, they have higher penalties. So you want to consider the penalties in the value proposition as well. It is not unusual a client will go and choose a lender just because of a rate. They have a lot of issues during their term, and then they have to pay out that mortgage. There's a giant penalty, there's discharge fees, there's other fees they weren't aware of because they were just looking at that interest rate, and it costs them a lot more down the line than if they just kind of looked at a few different rates and not just focused on that one aspect. And then there's also big benefits of dealing with known lenders. So you may have access to a lender with a lower rate for your clients. It may not be competing against anyone else. You may have a lender over here, but you know, a client has a 3-day subject removal, and you need a lender that you know can get the job done and get you that feedback and really give that security to clients. When a client's purchasing, they'll want to secure a mortgage, and they'll want to make sure something is in place. That's the priority for them. You don't want to be staying up at night stressing, trying to chase a lender to give you feedback, having the client calling you, kind of wondering what's happening, and it makes you just look unprofessional if you can't get that feedback in time for them as well. So you want to work with lenders that you know have turnaround times that work for you, that you know have good service, and also that have good underwriting criteria that works for you as well. Different lenders will underwrite in different depths, I suppose. If you have a relationship with different underwriters as well, they may ask for more or less. So by you knowing that, you can really structure and tailor which lenders you want to send a client's file to. The same application may be a decline with the lowest rate lender, but maybe accepted with another lender. Different lenders can be different, can have different flexibility in regards to what they offer, what qualifying criteria they have, and what kind of clients that they'll accept as well. So that can also be a big pitfall. If a client just focuses on the rate, they may actually be missing out on a lender where they could qualify for more or a different property, but the rate would be slightly higher. Or, you know, the rate may be slightly higher to amortize over 30 years, for example, but that's actually much better for cash flow for them, for their personal situation, than if they have the lowest rate amortizing over 25. There's lots of different things that you can kind of go through with clients, and different aspects that's important to review. So to summarize all of this, I hope this has linked in a lot of the information and reasons why just focusing on rate for individual mortgage brokers, especially when you're starting out and you don't necessarily have the sort of high volume to compete with some of these bigger companies that are just buying down rates all the time. You need to focus on the big picture and really, you know, excel in that education side, in setting clients up with products that work best for them, explaining that yes, we have access to these low rates too, but it may not be best for you because of these different reasons over here. So that's it. That's the section on interest rate. A lot of what we've discussed as well, there are tools that you can use. Include some of these key questions in your call structures. If you're using questionnaires, spreadsheets, if you're using a tool that we discuss in these videos, Tactical Mortgage Solutions, that kind of breaks down some of these things, and you can go through and ask clients the right questions to determine these types of things. That really helps as well, and it really helps find those reasons beyond just rate. You know, ask the right questions. Do you foresee needing additional funds within the next few years? Would you like a rainy day fund? Are you planning on moving within the next couple of years, etc., etc.? These questions determine, you know, a client may want a flexible mortgage, they may want a secured line of credit product, which may have a higher rate than one without one. So there's lots of different reasons beyond just rate, but I hope this outlines some of them and gives you a place to start in understanding the importance for yourself in not just focusing on the interest rate. That doesn't mean you won't get the best rate for clients. It just means that having the big picture view includes rate as one factor within a big picture of lots of different factors that will all together make the best picture and the best value for you and your clients.